Hello, this is Shine. My name is Shine, and I want to welcome you to Bible to Life, where we explore biblical principles to build our businesses, to create wealth, and to leave a godly legacy behind us. When we started early this week, this is a revision of what we have done in the past 6 days. I want to acknowledge and appreciate every comment that has come in, all of your suggestions. I have taken them into consideration, especially the questions. People ask some questions around debt. People are interested in how to secure debt and how to manage debt. So today I'll just be doing a recap of some of the things that we have learned, and I'll try to answer the questions and the concerns that were raised. When it comes to debt, I would like to let you know that there are basically four places where people can secure loan. You and I, we can secure loan from our family and friends, leveraging on our good name, our goodwill with family and friends. We can secure loan from family and friends. We can secure loan from cooperative organizations, cooperative where we have a relationship with them. We can also secure loan from where we work. Some organizations give 2 years, 3 year asset acquisition loan to staff backed by your salary. Those are good options for you to look at when you look at getting a loan. Then you can also secure a loan from lending institutions and bankers. And finally, the ones I would not like you to go are the Shylocks. The Shylocks, they give you unimaginable interest. It is usually when people are at a tight corner and they want to have unsecured loans that they go there. I want to advise, don't watch your finances get to the level where you need to go to Shylocks to get a loan. And I would like you to also know that first principles first. When you approach someone to get a favor of a loan, don't tell them about the need. People usually don't ask for needs because loans are destroyed. And now I'm talking about the first three options that I gave from family and friends, cooperative, and where you work. People would not give you a loan to fund your lifestyle. It's not good for lifestyle to cover uh, losses or debts, like a debt refinancing. So when you go to secure a loan, give a risk managed case, a risk managed case that has predictable cash flow. There is protection for the fund, and there are clear exit options. You give, I want to get this loan to acquire a machine for my business that is already doing £5,000 in a month's profit. I want to secure this loan so that I can get a machine that will increase my profit margin from 5,000 a month optimistically to 8,000 a month, and I'll be paying for 4,000 every month. So you give clear repayment terms and the time frame. This loan is for just 18 months, it's for just 24 months, it's for 36 months. So you need to be clear on that when you approach people for uh, a loan. Now, when you approach people for a loan, family and friends, if they really, really love you, they will ask you about your repayment plan. They might not ask you for collateral. They might not ask you for collateral. That is why the collateral you present in such instances is your goodwill, and it is a very costly thing. Your name, your standing in the community. Those are the things that you stand to risk when you approach your family and friends for a loan. So I want to advise you, please don't put collateral as collateral, things that you cannot lose. Don't use your family house as a collateral for loan. No matter how good the repayment term is, things can go south, and things do go south. So don't put your family house where you live with your wife and children as a collateral for loan. If things go south, it will be a very sorry case. if your family will need to be evicted from that property because of a loan that you secured. So don't use your personal house as a collateral for for a loan. Rather, you can use your rental property. If you have more than one house, you can use the other building that you have tenants in as a collateral, but not your primary uh, residence. So now let's now delve into securing a loan. Loan is a risk, and the first principle in risk management is risk avoidance. It is not every opportunity that you should pursue. It is not every opportunity that you should pursue. Try as much as possible to convince yourself if you can avoid taking the route of securing a debt. So don't borrow for consumption. Don't borrow for unclear purposes. Don't borrow for, now this is my own advice, don't borrow for a vacation. Take from your surplus for that. And if you are borrowing for your business, don't borrow to enter a market that you don't understand. When we talk about how you can grow your business, talk about going into new products, into new markets. Don't borrow to go into with a new product into a new market. You have not tested it. Everything can go south. Very, very high risky. So, and don't be a guarantor for loan to people. It's just risky. Avoid guarantees you cannot afford to honor. So risk avoidance is the first option. The other one is risk reduction. You can reduce the risk of borrowing. If you don't need £1,000, don't take £1,000. Reduce something from your consumption, from what you are doing presently. If you have 3 cars that you are using in your business, look at how you can, reduce the amount of money that you want to borrow. So, for a business, improve your cash flow controls and budgeting. Look at your budgeting. Where can you get savings that will reduce the loan that you want to expose your business to? So risk reduction when it comes to securing a loan. Then risk transfer. Like I said in the first place, it is not every business option that you should engage in. If you want to, for example, expand your business to begin to manufacture one of your raw materials, why don't you have sources? Instead of making all of the profit, 100% of the profit, why don't you share the profit? Give that idea, give that business to somebody else, and instead of making, let's say, £100 as a gain, why don't you just take £30 without borrowing? So you can transfer the risk to someone else. And you can also use insurance. There is an insurance that companies can use when you want to get a loan, credit life insurance or collateral insurance. You can do insurance. You can outsource high risk functions, and you can look at personal life. You can do health insurance for yourself, disability insurance, property insurance. You can transfer the risk. So you don't, the issue is that think about it. It is not, do you really, really need to take that loan if you can transfer the risk? In the second Kings that we read, the man that went a borrowing, maybe you should have transferred the risk of borrowing. You should have given that opportunity to someone else. And if you must borrow, that is, you want to accept the risk of borrowing, accept manageable interest rates. Accept repayment terms that you know you can honor. Don't start payment. For example, if you pay school fees and your children will get to school in a certain month, don't put that month as the starting point of loan repayment. If it is possible, look at your cash flow and how your expenses is for the period of the year, and look at how you can manage it. So accept manageable interest rate risks. For your business, accept that there will be market fluctuations. Put that before you make a commitment of this is how much I'll be paying on a regular basis. So risk acceptance, you look at what you can manage. Then on the fifth side is risk diversification. Risk diversification. Don't use your primary source of income. You have already taken a loan in the office. You are going to cooperative to also borrow money again on the same source of income. It is too risky. So try and diversify the means by which you are going to pay back the loan. Look for more customers in your business. Look for more products to sell so that you have a more wider spread to ensure that you don't default. The issue is you don't want to default payment. You don't want to default payment. So you diversify the risk. Then risk sharing. Risk sharing. Share the risk. Let your wife also join you if you want the money for a family business. Don't be the only one. Share the risk. Share the risk. Let your brothers or your sisters, why instead of borrowing from them, make them part of the business and let them bring their capital in, not as a loan. So you can share the risk. For businesses, this is where joint ventures come in. This is where joint ventures come in. If you want to go into a business and there are other people that are also doing that, you can invite them to join you in the opportunity and you can share the risk. So you should look at people that will borrow with you instead of borrowing the £10,000 alone. Let your son that is working borrow £2,000. Let your spouse, your wife, borrow £3,000. You borrow £5,000. You have shared the risk so that only one person would not be burdened. So then you must look at how you monitor the risk. You must monitor your risk, the debt to capital repayment ratio. You should look at it. Monitor the debt, monitor KPIs in your business, monitor what you are using the money to do so that you don't default in payment. Make sure you monitor what you are using the money to invest in. And I would say, please don't borrow money for lifestyle. It's too risky. It's too risky. Men are in sizes. Maintain your size. Maintain your size. You do well. Then contingency planning. Before you borrow, do you have a backup repayment plan so that if things go south, you will not be you will not face the uncomfortable situation of not paying. Then hedge the risk. Fixed interest rates. Don't do a loan that is compounding interest. No, look for fixed interest rates. And if you are borrowing based on in a foreign currency, try and look at hedging your currency and the price. So so that you will not suffer for fluctuations. It has a plus and a negative effect. Uh, all of us optimistically we look at the positive effect, but when you want to take a loan, look at the negative effect and hedge against it happening. Hedge against it happening. So I will just leave you with these few risk management options. There is control uh, that you put in place to make sure that uh, things cropping up does not disturb your your repayment plans. So you will not be in debt. You will not end your life in debt. My personal advice and counsel is be a good man in your community and to your family and friends. Look at getting loans only for asset acquisition and for business. Look at getting loans from family and friends. Those types of loan are usually without interest. Look at cooperatives. The interest in cooperative loans is not very high. And every opportunity where you are working, if you are working, every opportunity that is presented at your place of work to get a loan to buy assets, please try and assess it. Assess it all of the time and use it to get assets. See you next. Share, like, and pass your comments. From tomorrow, we'll start looking at how the woman in 2 Kings chapter 4, how she was able to solve the problem of the debt. You have a debt, it will not go away. You have to look at the debt, you have to pay the debt. The woman paid the debt, but what are the biblical principles that she engaged to pay up her debt? I want to speak to you today. If you are living in debt, that you don't have to commit suicide. You don't have to leave the city and run away. Face your demons. Acknowledge that you have a hole. Don't dig deeper. Apply these strategies that we shall be looking at from tomorrow, and I see you out of debt, hope becoming a lender to others. Thank you so much. See you soon.